Please see where somebody is on. Shivang Buch, please go on mute. Arpit, please go on mute. Gautam Tiwari, please go on mute. Milind Dagar. Anyway, so I am starting now. This standard is linked with, of course, Ind As 32 and Ind As 109. Now, my idea here is not to share the basics, because Ind As 32 is presentation, Ind As 109 is recognition and measurement, and 107 is disclosure. I suppose that anybody can get by reading the standards itself. Similarly, IAS 32 under IFRS, to which India's converged standard is Ind As 32, or IFRS 9, whose converged accounting standard is 109, and IFRS 7, whose converged accounting standard is Ind As 107. Or IAS 39 has been replaced by IFRS 9. As of today, I would say these are all known information, so I would spend time on that. I would directly go to the crux of the standard, where we all, I mean, including me, we get stuck up. Rahul, mute please. I would appreciate everybody remains on mute, because then you are not only wasting your time, my time, and others' time. And OnePlus 7 Pro. I would appreciate if everybody is on silent mode. And therefore, this webinar is I think, my Dasara gift to all my students. And I can see that a lot of my friends have also joined. In fact, some of them are my gurus also. Like senior person like Mejaji is here, or my very intelligent friend Preeti is also here. So everybody, I mean, I have learned from. And I think post 1st April online, we held more than, I taught in more than 27 batches. So there is a big number who is, waiting to appear for the exam. So when you, Arpit, please, it's not on here. Arpit, go to mute. I think every 2 minutes, if somebody is going to be unmute, I have to find very difficult to complete my lecture. Okay. So, So 32, 109, 107. And for that matter, everybody should say, we know the 4 principles: presentation, recognition, measurement, and disclosure. So what is presentation? Where and how to show in the financial reports or financial statements, like for example, balance sheet, P&L, OCI, SOCI, etc. And I'm going into the little basic details also because some of the people who are doing IFRS course also have joined here, diploma in IFRS. Some people who are doing CA final exam also have joined here. And that gives me an opportunity to share the thoughts with all. One can see here, and always remember RMPD. Okay, RMPD. This is my easy way of remembering. Every asset or liability has to have a recognition principle. How do we recognize whether somebody is a boy or a girl, or somebody is something is a house or tree? Similar way, we have to recognize something is an asset or liability or equity or income or expense. That is called recognition. Now, within that recognition, whether it is a financial asset or non-financial asset, among financial and non-financial asset, if it is a non-financial, then whether it is tangible asset or intangible asset. If it is a financial asset, then whether it is debt or equity, that is precisely called as recognition. Because a lot of people ask me what is meant by recognition. Measurement. Measurement means measure, as the word says, measure. Measuring is quantifying, talking about amount. Pintu Sharma, you go on mute. So, Pintu Sharma, go on mute, please. So, one has to measure it. Okay, measure means quantify. Now, quantify, when we got into the era of Ind AS, there are a lot of things which go at fair value. And particularly, financial instrument is one standard where fair valuation is almost in most of the cases, or almost all the cases. Okay. Redmi, please go on mute. Then we talk about presentation. As I said, presentation, where are you going to show? I mean, is it in current liability, non-current liability? Are you going to show on asset side or liability side or income or expense? And within P&L, are you going to show in OCI or P&L? And are you going to show in SOCI? Where will it appear in cash flow? All these things matter.
Yeah, thank you, Mohan.
iPhone, please quiet. Then disclosures. Disclosures, Redmi, please quiet. Disclosure means notes to accounts. Okay. So in the past, we used to say disclosure notes, or we used to say notes to accounts, or we used to say schedules. Now all that has been combined. Now it is the combined name is disclosures. And while publishing in the reports, we say notes to accounts. But disclosure, notes, and schedules, everything is one now. So don't get confused by all this. So a lot of things where how the fair value policy is maintained, or are they recognized at what types, etc. Then if you talk about the case like bank's balance sheet, okay, essentially everything is a financial instrument. Okay. So then when we start talking very broadly, and I'm going to make a very loose definition. Okay, I'm not going to go very scientifically. Okay, first a very loose definition. So I'm taking here what is all covered in this standard. What is a financial asset or financial liability or equity? Of course, equity is not covered in 109. It stops at 32 itself. Okay. So having said that, if A Limited invests into equity shares of B Limited, A Limit, Durga, mute please. If investment in equity shares, A invests in B Limited, that's a financial assets. Or A invests in debentures or bonds or options, all that is financial asset. Or A Limited gives a loan to a LLP, still it is a financial asset. Okay. On the other hand, whatever loans are taken or debentures issued, they are all financial liabilities. Then trade receivable and payable. I always used to wonder when I passed in 1980 and as a CA, and over a period of 40 years, there was a big amount of journey when we kept on learning new accounting standards coming up, and a major change came in life in 2000. There is a standard for every asset, like fixed asset or lease standard, revenue standard. But I always used to wonder, as far as debtors and creditors, now we call it receivable and payable, where is the standard? We used to be only knowing more than 6 months old and less than 6 months old. There was never a standard for sundry debtors and creditors. Jokingly, we used to call it a Sundari debtors. Okay. And even for many years, I had a doubt about this word. What is sundry? Why it is called sundry? Sundry means minor. But that is coming from the world where most of the transactions were cash. So therefore, the credit period used to be sundry, a rare case. So now it is trade receivable and payable. They are covered under financial instrument. Similarly, other receivable and payables also. Then loans given to employees or loans taken from outsiders. I mean, normally employees don't give them, but loans given and taken from employees, outsiders, group entities, which are either payable in cash or financial asset or financial liability. So for example, if A gives a loan to B and says that it has to be repaid in the form of land, then that's not a financial asset. Neither that is a financial liability. Then again, cash and bank. Cash and bank balances are something where we get the money from RBI or Gandhiji. Then we keep the fixed deposits with the banks, corporates, governments. Those all are there. So all these things are basically financial instruments. So if you open the bank balance sheet, what they used to call as a dead stock, land building, that is very minor. Then banks have hardly any machineries. Nowadays, of course, banks have bought robots also. But I mean, compared to the size of the deposits and loans, that is peanuts. So banks balance sheet, I would say value is 99% are financial instrument and 109. Luckily, in India, the Ind As is not made applicable to the banking industry yet. But NBFC people are facing, and people have faced challenges during last 2 years. As you all know, I happen to be independent director on LIC Mutual Fund Asset Management Company trustee. And then it is a subsidiary, it is an associate of LIC Housing Finance. So we had Ind As already applicable. Okay. So having said that, the normal company, manufacturing or services industry, they have many items which are not falling under Ind As 109. In fact, I would say all three, but primarily today's focus is 109. And all said and done, 109 is a major standard. So I'm making here the list of what doesn't fall in financial instruments. And how important is financial instrument? See, first of all, Ind As is balance sheet oriented. So you all must be knowing. In the past, whenever we were seeing a financial report, we used to say, oh, how much is the profit or how much is the dividend? Now we are more concerned with the survival of that company. And survival and only what is the net worth of that company. I mean, equity should be looked as a dividend gaining instrument, or should it be looked as a capital X appreciation element, is a way of thinking. But I think the things are changing. So the balance sheet and net worth aspect makes a difference. Now, PPE is a new name for fixed assets. New name for fixed assets. Now, I'm not going into why fixed asset was made PPE. PPE long form is property, plant, and Pawan, mute please. Pawan, mute please. So property, plant, and equipment is PPE. Then we talk about intangibles like brand, patent, trademark. They are all intangibles. Then we talk about inventory. Now many people feel that inventory, when you have, you get the cash or check. So is it not a financial asset? But inventory, unless it is sold and converted into trade receivable, it is still not a financial asset. So anything which is directly convertible to cash is something what we are talking about is a financial instrument. Then we talk about defined benefits. I think many of us who are CAs were always used to be scared of this standard because it belongs to gratuity and pension and whatnot. Now, gratuity and pension is payable in cash. So certainly we might feel that why this is not a financial instrument. But per se, this stands excluded. And if I have to give you the logic behind it, the valuation of gratuity pension is more on actuarial science basis. So the mortality rate, etc., are involved. So though on paper it will appear that it is payable in cash, it should not be, it is not covered under financial instrument Ind As 109. Then of course investment property means property held for appreciation or renting. And normally the principle of property held for appreciation is not really encashable. We are looking being opportunistic. So as and when it goes up at an appropriate time, that is where we talk about. So hence, investment property is not a financial instrument. So we are talking about investment property, which is not a financial instrument. And therefore, the question of investment property not being a financial instrument is coming also from the fact that if you recollect, AS 13 used to have a title called investment, and is used to combine investment in shares, investment in property, and investment in anything else like gold also. But that is gone now. The clear split under the Ind As is financial and non-financial. Then we talk about agriculture and biological assets. Then we talk about exploration and evacuation assets. Then taxes payable. Now here again one will get a feeling that if the taxes payable are in cash, why are we looking at them as a other than financial instrument? Sridhar, please go on mute. Sridhar, go on mute. So taxes are payable in cash, but financial instruments require a contract between two parties. And we don't have a contract with government in the tax. Actually, it is arising out of taxes payable are arising out of constitution. Okay. All right. Then next is prepaid expenses. So the concrete example, immediately somebody says prepaid, what comes to our mind is prepaid insurance. When we pay the insurance, then obviously we are expecting the portion of insurance cover which is available in next year, and therefore in current year we called it prepaid expenses, prepaid insurance. So we are not really expecting the money out of it, we are expecting insurance cover. Or prepaid rent, we are expecting the availability of the building or machinery for use. Then advance to suppliers. This is primarily to get the goods and services in return. Or advances from customers. This is primarily to get the, supply the goods and services against it. Then travel advances. We are supposed to get the travel vouchers from the employees. So other than all this, everything else in the balance sheet is financial instrument. Okay. So I talked this at long, but my main question to all of us is, what is so special? Why are we talking financial instruments separately and other than financial instruments separately or non-financial separately? There I will give you one simple trick. Okay. What is special in treatment? One is present value. Okay. So anything and everything in financial assets has to be recorded at present value. What do we mean by that? Let's say if we have a supplier who has given us 1 year's credit, then we should discount and record the goods and services purchased as well as payable at present value. Simple. So even though the supplier might have raised the bill for say 121 and given 2 years credit period, if the normal interest rate is 10, I will do it divided by 1.1 raised to 2. And I will record an entry of goods debit 100 to payable financial liability as 100. Okay. So you might have received a bill of 121, mind well. And this concept was unheard of. We always felt that the recording has to be done at the bill value. All right. So the goods value also itself comes down. The financial liability value also comes down. All right. Then we talk about effective interest rate. Okay. We have to record the transactions at effective interest rate. What is the effective interest rate? So in a layman's language, I will say effectively what is the interest rate? Okay. Now, let us say if the normal market rate is 10 and somebody had charged you at 20%, okay, then that will amount to effective interest rate. But then whenever you come across such a transaction, that effective interest rate is different than market rate, we need to understand one very solid and important thing. That is, this effective interest rate has to be equal to market rate. Otherwise, there is some issue. What is the issue? The issue is two possibilities. Either the intention is good or intention is bad. If intention is bad, then the discounting at effective interest rate, which is not a market rate, will result into showing the real picture. And we will take some examples of that. What could be the examples of that? We will take them. But just to give a rough idea, when a company gives loans to its employees, they give it interest free or at subsidized rate, and then it is really not at market rate, but we understand the substance behind it. What is the substance? Let us say the market rate is 10% and employees have been given the loan at 3%. Then we know we are already using it in income tax. The difference of 7% is salaries. And that is what Ind AS really identifies between market rate versus the rate used actually or rate applied actually. So we can take different cases, and such kind of case studies will come in your valuation exam, will appear in your valuation exam, especially case studies also. So let me open my Excel sheet and show you some of the possibilities, what can happen. Let me open an Excel sheet to make the things clear. I hope you are able to see my Excel sheet. And let me see. Any queries you can start writing in the chat mode. Start writing queries in the chat mode, because I will go in the sequence at the end. So first queries I will take first. Of course, if I have covered that query in the teaching, then I won't cover it. All right. So let us take some case studies. And for that, let me make the font size bigger, which will give you an idea. Raj, mute please. So let's take a transaction, employee loan. Infosys gives a loan of 500 crores to employees at 3%. 500 crores at 3%. And in all cases, for simplicity, I am presuming market rate is 10%. So now what's happening? In the normal case, I would have said 15 being the finance income, or in our traditional language, interest income. But now what we will say? We will say this into this is a finance income. Finance income. And this minus this is a employee cost. I'm generally giving a generic name, or you can say salaries, wages. Let's take a second example. Second example is we have given a machinery to ancillary supplier who manufactures and gives us the components at a subsidized rate. So let's say we are supposed to pay 10 rupees for 10,000 components in a year. But the market rate for that is 12. Okay. So then what happens? The difference goes to material cost. This normally in the old situation we would have said this is material cost. Now we will say this is material cost and the difference is income. Difference is finance or sale income, receivable, and that amount will be required to be capitalized over the projected value. Let's take the third example. Suppose we have given a loan to supplier at a zero interest rate. Okay. And the supplier supplies at lower price. Then the difference is finance income on the loan given. So it means if our purchases are 10 lakhs cost in the bill, but actually it may be 12 lakhs cost actual versus 2 lakhs finance income. So I'm giving you many examples. Let me take two more examples which are very common and then rather move forward on this. So essentially splitting the element of a finance income and finance cost nature is something which Ind AS 109 ensures so that hidden transactions don't happen. Take a case where we have given security or deposit. Okay. In one case, deposit given was 1 crore and rent was 10 lakhs per annum. And in the other case, the deposit payable was 5 crores and where rent was 1 lakh per annum. I'm just doing out of the thought. And the contract in both the cases are 10 years. What shall we be doing? What we'll be doing is we'll be calculating the interest on this in each case and adding it to the interest per annum, rent per annum. Then only we are really showing the correct picture. Otherwise, in one case, we will be showing a deposit of 1 crore and 5 crore, showing it as an interest free and then accounting for it without any interest. And then it does not reflect the real picture because the P&L of two companies will be showing a difference of 9 lakhs and the company A will be showing lower profits and B will be showing higher profits. No, that's not all. So what you will be required to do? You will be required to discount these deposits. Both these deposits will need discounting. Yeah. Let me take one more case. So when you discount it, the interest portion of this, even though it is interest free, I think I should have written here interest free. Interest portion of both of these should be going into the rent part. And now let me come to the last example. There are many more, but the most common are interest free loan to supplier, subsidized employee rent, Sanket mute please. Then deposits for leasing. Then keeping the sort of advance payments and like that. And the last one is convertibles. Many times the convertible debentures end up into what is known as, we talk about convertible versus non-convertible. The non-convertible simple and straight debenture, a loan with interest, and normally should be at market rate. On the other hand, convertible include an option to convert. So in that case, we need to split the option valuation. And there are OCDs and CCDs. CCD means cafe coffee day. No. CCD means compulsorily convertible debentures. And OCD means optionally convertible debentures. So there we are required to split that element. Another issue which is not very well known in this case and very commonly understood or becomes an issue is that whenever we have CCD and OCDs, there also, if you take the plain vanilla, it's a very common word called plain vanilla debenture, that is a date. So now we talk about debt equity bifurcation, debt and equity. What is the difference between debt and equity? The other day I went to one of the banks and he started telling me, you look, our bank gives a higher interest rate. So I told him, no, I will keep my money where return on investment you are offering me higher, but I am asking you what is the return of my investment. Is my investment safe and secure? So nowadays, return of investment is more important than return on investment. So remember these two simple wordings, return on investment, return of investment. Return on investment in case of a debt is fixed or floating rate. Whereas in case of equity, what is it? Not sure, uncertain. You may pay dividend, you may not pay dividend. Okay. Depends on profit and loss, depends on dividend policy. And return of investment is on a finite defined period. That's a date. And here it is. Shall I say perpetual? Let me say perpetual. Okay. It can remain for long term. It can remain at the time of closure of the company, you may have to refund. Unless somebody comes up with a buyback scheme. But in the original case, there cannot be a redeemable equity shares. If you come to I had seen this joke happening in Mr. Sumit, mute please. 7th October 2012, if you read the business standard, one chori was caught where the company had issued redeemable equity shares. That too to the foreigners. Now what happened to that case is a separate discussion, but you can go to business standard issue of 7th October 12. And the name of the article is Banana Republic. Okay. So somebody who needs that article can contact me afterwards. Okay. Everybody has my WhatsApp number in any case. Okay. So having said that, what about perpetual? And against perpetual, let me say, if we are saying that redeemable at option of investee, I mean the company itself. Redeemable at the option of the investee. Redeemable at the option of investing. Would you call it a perpetual or not? So if you want to call it, Vishal, mute please. So if you want to call it redeemable at the option of investee, that is also treated as equity. That is also treated as equity. For this purpose, you can see a Tata Power or Tata Steel balance sheet. If anybody has more interest, they can contact me separately. So now in the Tata Power balance sheet or Tata balance sheet, we find that there is a perpetual instrument or the instrument which is redeemable at the option of Tata Power, but the rate is fixed. Now, is it a debt or equity? Which criteria is more important, return on investment or return of investment? And the principle laid down is this becomes equity. Okay, so they have titled it as unsecured perpetual securities, and they have been classified as equity. Classified as equity. So those who are keen on learning financial instrument more and more, I would recommend them to study the Tata's balance sheet. All right. So debt versus equity, two principles: finite period and finite returns, and equity uncertain returns and perpetual period. Now, having said that, if perpetual or the, that is a more important principle. When is going to be returned is a more important principle. So with this, I will move back to my slides. I hope you are clear. There are some queries coming up as I'm seeing, but I'll come back to them later. So what is special in the treatment? Effective interest rate, and I presume we have agreed that, understood that. And obviously you should take the present value. The another beauty is there used to be a smart manipulation by calling not interest as an interest, but something else. What do you call it? Hidden cost. You know, many times there are hidden costs. So for example, some direct costs like bank charges, processing charges, documentation charges, stamp duty, registration fee, premium or discount on issue or redemption, then recurring charges, etc. So having said all of them, Brooke, all of these, silent please. So all these are now will be included in finance cost or financing, right? So one should not now say these are as separate costs, and therefore the effective interest rate will be calculated based on considering all these factors. I used to, you know, we all CAs and others professions feel that we are very intelligent. And one day I went to my mother, who was not so highly qualified like me. So, and I wanted to take a loan of 1 crore, 100 lakhs. Okay. I wanted to take a loan of 100 lakhs. 100 lakhs loan I wanted to take, and I went to HDFC and I went to ICICI. Loan amount. And the interest rate, I'm just saying hypothetically, was 10%. And here it was 9.95%. and there was a one-time down payment of processing charges to be made by me was 0% here, and here it was 1%. So all of you now, I request you to reply which loan is better for me, which loan is preferred by me as a borrower, HDFC or ICICI. Please reply in the chat mode immediately so that I will know that you are all awake. Right. So don't reply privately, reply publicly. Amit Singh, reply publicly. So having said that, you will realize that I would ask you a question in view of this, that can you tell me mathematically, prove me mathematically or arithmetically why HDFC is economical or cheaper or preferred? Yes, prove me mathematically. Yes, prove me mathematically. Give the calculation. I will not accept it just because you say. Show me or tell me calculation. All of you are replied as tell me calculation. Tell me calculation why HDFC is preferred. All right. Raghu, mute please. So now, Rahul Gadkari, how do you calculate IRR? Tell me, how should I calculate IRR? Now Durga and Vishant are asking tenure. So why did you give a reply without knowing the tenure? Durga and Vishant, why did you give a reply without knowing the tenure? If you don't know the tenure, how can you say that HDFC is better? So with this kind of doubt, once we become CA or ICWA, that is CMA or company secretary or MBA finance, हम लोग खुद को बहुत बड़े समझते हैं. First of all, if you want to give IFRS exam or valuation exam, forget that you are a CA or CMA. Because as a CA, we have the habit to make simple things difficult. So I went to my mother and asked her, okay, I need tenure, then only I can find out. She said it requires a simple brains. Your interest is 10 and your loan is this thing. Here your interest is 9.95 and loan is, the amount which you will get in your hand is 100 minus 1. And now if you take the ratio, okay, then you will get a figure of you can see here. So whatever is the tenure, this rate will always be higher. Please understand. So don't have an impression that tenure makes any difference. In fact, one of my students has tried to do a calculation of 200 years. The figures nominally change, but this figure, whatever tenure you take, will not come below or even equal to 10. So when she told me that, I was shocked. I said that I am such a person with triple qualification and first attempt rank holder and all that, and 40 years experience, and I don't know such simple kind of things. So valuation exam and IFRS exam are great ego busting methods. If somebody has an ego, please give valuation exam. Then it becomes very easy to understand. All right. So that is where the example about this comes. So let me take a debenture issue. Let me take a debenture issue. Debenture is issued of 50 million, and 1% was the stamp duty which lender spent. Kishore, mute please. Kishore, mute please. 8% interest payable annually in arrears. Term is 5 years. And repayable at end of 5 years with, but there is a premium on redemption, 8 million. Sumit Gupta, mute please. Sumit Gupta, mute please. Sumit Gupta, mute please. Okay. So, how will we calculate the effective interest rate for this? Effective interest rate for this is, sorry, here it is. Let me take for simplicity, 2%. So then what happens? This becomes 49. What inflow you are getting? 49. What outflow you are getting every year? 4. I hope you are all understanding. 8% of 4. Sorry, 8% of 50. So here I will say 50 minus into bracket 2% into 50. That is how 49. And then here I get 50 into 8%. But I should do minus because that's the outflow. Okay. And then if I continue like that, then I will get first 4 years same. In the 5th year, my outflow will be minus 50 minus 8 and minus 62. 50 plus 8 plus 4. Now I will go to function X and use IRR. Can you see here? Internal rate of return. And say OK. Then it asks me the range. So I drag like this and enter. Can you see what is the rate? 11 or 11.1, 11.11. It means that what on paper appears to be 8%, rate on paper, but real rate, real cost for borrowing is 11.11. And that is what is precisely called as EIR. EIR implicit rate or implied rate or inherent rate. Remember, EIR, implicit, implied, inherent, all these are same terms. Okay. All these are same terms. Now, whenever I am doing an accounting for a financial asset, what I will do is, because Ind AS standard is, first of all, to start with, it is for accounting, financial reporting. So I will pass an entry, bank debit to loan. Investment in debentures debit to bank 49. Then I will pass an entry, investment debit to finance income. And then bank debit to investment. So we have learned something like principal plus interest accrued and due, etc. Something similar. So I'm showing you what is known as a loan table. So how will I use the loan table? This into my effective rate. What is my effective rate? 11.7. Can you see that? So my figure here will be this. But my figure here will be 4. Okay. So my figure here will be my closing balance of the investment will be formula auto sum, and then I carry forward this, and then if I drag in a similar fashion, okay, you can see here, yeah, and I'll drag this also, and I'll make the whole thing 2 decimal so that we don't have and I need to do here dollar. Can you see here at the end I'm getting 0? So actually my investment will be recorded like this. It will be recorded like this. So we need to understand that the effective interest rate principle under financial instrument is completely different. In the previous way of accounting, we were doing something different. So I hope we have now clear. Are you clear up to here, or anybody has any query? I will take a break of you don't have to incorporate deferred tax. We should calculate deferred tax separately, Vishant. Kishore, whether incremental rate of borrowing is same? Well, we will discuss that separately. What is effective rate of interest? Why are the subtracting stamp charges? Because a cost incurred directly or indirectly in order to get that loan. If you are spending it, it should be considered. Now here we are presuming that the investor has incurred it. So therefore, I think I have made it from the borrower's point of view. My mistake. I think you're right, ABC. This is from borrower's side. My mistake. I should not deduct borrower's side. ABC, you're right. From the investor, if investor is going to spend, it is other way around. Okay. ABC, you are right. I don't know who is this ABC, but this is from borrower's angle. And let me presume here stamp duty borrower spend. Okay, I stand corrected. So now is it clear to everybody or is there any query? So the liability will be shown 49, 50.44, 52.4, 53.82, 55.80 and 0 at the end. Is everybody clear? ABC, are you clear? Interest 8% on 4. Additional 2 nahi. I don't know what you mean. I'll see the other questions. Your question is not clear. Whether incremental rate of borrowing is the same, Kishore, we will discuss this. See, basically what happens? What is the incremental rate of borrowing? The effective interest rate has a concept of opportunity cost. So if you are borrowing at different rates and you want to apply the rate, market rate, in order to do discounting, you should take that rate which, had you borrowed more or had you invested more, you should have got. So yes, in a way, incremental rate. ABC, your question is not. I'll ignore that. Right. So I go back to my slides. So every cost or income linked will be considered separately. I think, let's not make a bogey called zero coupon bonds. It is simple. You take the inflows and outflows. You take the inflows and outflows. So I will do this, solve this query immediately. Let's say zero coupon bond. Today I am investing 70 minus 70, and at the end of 5 years I am going to get 100. So then I should straight away do an IRR of so it's 7%. And then how I should apply is very, very simple. So if this is a financial asset, I will take first 70, apply to that 7.394, and then add up. And here I will do dollar. We have to remember one thing. Interest is a period cost. So nothing like zero coupon bond and all bond. Just simply capture everything in, what do you call, inflows and outflows yearly. Monthly, if there are payments, the payment calculation becomes complicated. So at the end you will get 100 and the 100 will be received back. or paid back, and then it's closes. Have you understood, my dear friend Vishan? No, that one-time charge concept is gone, Mr. ABC. One-time charge concept is gone. There is nothing like a principle. Okay, Mr. ABC, nothing like a principle. Okay, so I have replied ABC also. Now we go back to the slides. So though my slides are going slowly, my idea is to give you as much idea. So what's a financial instrument? On one hand, there is a financial asset. On the other hand, there is a financial liability or equity of others. You can have financial liabilities on both the sides also. So you exchange debentures with preference shares or loan with debentures, or you exchange equity share of A Limited with equity share of B Limited, or you can have cash paid against receivables or debentures paid against payables or receivables, anything. So it's a basically exchange between two financial instruments. Then we come to contractual rights. So if they are potentially favorable, then that's a financial asset. If they are potentially unfavorable, then it's a financial liability. Okay. Yeah. Then we go to equity. Equity is residual rights. So in the past, we were thinking equity means equity share capital. Now equity means, in our old language, share capital plus reserves and surplus. Share capital plus reserves and surplus. Whereas, so whatever बचा कुचा जो मिलेगा वो इक्विटी शेयर होल्डर्स को मिलेगा. The simple Hindi language is बचा कुचा. So we'll have three situations: financial liability, equity, and financial asset. And the challenge comes between debt and equity classification, which we talked. All right. Then convertible will split between option value and now I am going for an important part as to how do you classify and measure investment, that is financial assets, into equity and derivatives. So let's touch equity first of all. If A Limited has invested into B Limited equity shares, then the first criteria we should put is it held for trading? If yes, you should take the difference to FVTPL. Now many of us are not so savvy with the latest standards, or we are company secretaries and more in touch with law. For their purpose, I would first touch this word called FVTPL, that is fair value through profit and loss. Okay. So once you become a finance wizard or valuation wizard, you must know a word called FVTPL. What is FVTOCI? FVOCI is fair value through other comprehensive income. Now, first of all, let us see what is meant by through. Through means putting the difference in the fair value through profit and loss, or putting the difference in fair value through other comprehensive income. That is called FVTPL and FVTCI. Pinto Sharma, mute please. Pinto Sharma, mute please. Okay. So now, what is OCI? Other comprehensive income. What is other comprehensive income? The new concept under Ind As makes two parts into profit and loss account. One is normal profit and loss, and second is other comprehensive income. Now, just to give a simple idea, which are the items which are taken into other comprehensive income, and what is the speciality of other comprehensive income? Okay, so I think I have done it here somewhere for the knowledge, or alternatively, I will write down here quickly. I think I will, for the benefit of everybody, because that is taught under some other standard, but here it is high time that we understand what is other comprehensive income. So simply speaking, let me reach a situation of creating an extra slide better. Okay. Yeah. So since we are on the sharing mode, let me go to this.
Sir, this presentation would be shared or should we note it down?
It will be shared.
Thank you.
No need to note it down. Only thing, Anjali has created the WhatsApp group. So you will need to remain at least for one day in a WhatsApp group, because I'll be doing some improvement and the presentation will be shared in the WhatsApp group of the people who have registered for the program. If you are not registered, go through the link and register first. But I am happy that you people have found the presentation useful. So while on this subject, let me make one more slide here and simply give you an idea. What is OCI? What is OCI? Because P&L, so I hope you know. Because if I have to teach you P&L, you should not be here. OCI is other comprehensive income. Items in that are 7. 7 fixed. You can't add, you can't reduce. If you want to add or reduce, ask the accounting standard board. And then they are not considered for dividend. For dividend, you can consider only P&L's net income. Then not considered for EPS calculation. And third is normally these items, not in management's control. So like revaluation reserve or change in the fair value of shares, what will management do with that? So there are, I won't call them exactly non-operating, but very broadly, or they are like notional items. So that is the difference between P&L, because Ind AS wanted to show the performance. So I'll open my slide for sharing so that you will get an idea. What is OCI? Can my slide be seen now? I hope so. Can you see the slide now? Okay. So What is OCI? OCI is other comprehensive income. There are 7 fixed items. We need not discuss them all. It is not considered for dividend. Only P&L items will be considered for dividend. So it's like a parking lot, they call it. It's like a parking lot. Now we are talking about some query. Question was, since there is no intermediate cash flow, it is difficult to take it out from the FVTPL, especially if the security is lost. Take it out from FVTPL, I don't understand what you mean, Vishan. Take it out of FVTPL means what? I don't understand. All right. So that brings me to the slide presentation continued. So now that you have understood that if it is held for trading, then I will route it through P&L. What is meant by routing through P&L? Simple. If I have bought the shares for 10,000 on say 7th November 2020, and I am showing them in the balance sheet on 7th March 2021, and they have become 13,000, then I should show them at 13,000 in the balance sheet, and the difference in the change in fair value I should take to profit and loss. All right. On the other hand, if they are not held for trading, then we have a choice. Choice means option selection to route that difference through other comprehensive income. Provided, now this is very important, provided it has to be initial. It has to be initial at the beginning itself. And it is irrevocable. Mind well, we are talking about equity only. Don't mix up with debt or derivatives. So at the initial stage itself, we should make a choice that it will be through other comprehensive income. If you do that choice, take the difference through OCI. If you don't do that choice, again you are back to P&L. And then, as I call it, die in equity. If you make this choice, even the profit on or loss on that sale of equity share also goes to OCI. So it never goes to P&L. No reclassification. Okay, no reclassification. Right? Since there is no reclassification, we shall be reaching a situation where the FVT through OCI, okay, equity through OCI is for the items where we are normally looking at it as a long-term investment, and we are treating them as a not so connected with the operating business. People classify it to OCI when they don't want to mix up their operating business performance with that and destabilize the P&L figures trend. But on the other hand, those profits and losses are like a surplus fund investment, honestly. So one should look at that profit or loss separately. But then it's clear that at no point then you can use it for dividend. All right. Now, I'm talking about derivatives. Derivatives means what? Options and futures. Now, derivative itself is a topic for discussion at length. Okay, derivative itself is a topic at length. So, therefore, derivatives should be valued, and the difference in the options, futures, forwards, whatever, puttable instruments, etc., at fair value change. So suppose you have a put option or a call option, then you should value that at fair value through P&L. Now the only exception it gives is it can be through OCI if it is for hedging. So normally derivatives can be speculative or for hedging. The speculative will always go through P&L. The hedging also will go through either P&L or OCI, depending on how the hedged item is classified. So hedged item is falling here, then this will also fall in OCI. But if hedged item is falling here, then derivative will also fall here. So it is a revenue cost matching principle. As far as derivative is concerned, it's a revenue cost matching principle. Right? Okay. Then we go to financial asset debt. Debt means investment in loan, investment in debentures, investment in preference shares. Remember, anything other than equity. I mean, what is the principle behind debt? Principle behind debt is other than equity. And what is equity? Perpetual, primarily, and variable returns. So in case of valuation and classification and measurement of debt, if you select FVTPL by default, then it goes through PL. So let's say I have invested in debentures and I am going to have this debenture is listed. At the end of the year, the price of the debenture goes up or goes down. The difference between the two, I choose FVTPL, I put it to P&L and value the investment at market price. In the olden days, we used to call it MTM, mark through market, something similar. Then we come to contractual cash flow characteristic test, met or not. What is the contractual cash flow characteristics test? Convertible debentures don't have a contractual cash flow characteristics. Therefore, you are required to split. Or suppose I have a loan where I say that I will repay you in 10 years, whatever amount can pay you every year, as and when possible. So then there is no contractual cash flow characteristic test and you cannot calculate EIR. So if that is the case, again you have to go through FVTPL. Again you have to go through FVTPL. And then the next one is business model test, met or not. Are you having a business model? Now this is also called as SPPI, solely for the payment of principal and interest. Remember, solely for the purpose of payment of, solely for payment of principal and interest. Solely for payment of principal and interest. So if you are holding it, like in the old words, we used to call it HTM, held to maturity. So here, collect the contractual cash flows, then you don't go at fair value. You record it at amortized cost. Amortized means calculate effective interest rate, allocate it. At the year end, on the balance sheet date, don't do fair valuation. Normally, this will be done when you have no intention of trading into them. You have an intention to hold till long term. And you are making it as a choice that this is my model, business model. Like for example, if I keep a fixed deposit with bankers, generally I don't intend to break. But sometimes I may choose a model, I call it CCCS, Contractual Cash Flow Collection and Sale. In that case, I should move through OCI, but in this case, it is a recycled. So on closing, on sale of debentures, it goes through OCI. And there could be a third probability, neither hold to collect and nor hold to collect and sell. Then you go back to PN. So the investment in debenture can go at amortized cost or OCI or PL. So there are three choices. If the business model test is met, then you have amortized cost of fair value. All right. Now, what are we left with? We are left with financial liability, we are left with impairment, we are left with hedging, we are left with derivatives, and we are left with expected credit loss. But on the request of a lot of students, I am going to arrange 2 more free webinars for those, because we can't do justice in 15-20 minutes. So the next 15-20 minutes, I am going to spend on 2 things. One is, I would like you to answer the MCQ created by me, multiple choice question from the exam angle. And second, I would like you to ask me queries. So first, I'll take your queries. Go back to the chat mode and ask the queries. Afterwards, I will take the MCQ. And then for today, we'll conclude, but I will declare the next dates for the purpose of let me see in the chat mode what are the queries. How to decide whether it is trading for investment? How to decide means it is your money, your investment. Mr. ABC, how to decide means it is your investment. So you decide, right? I mean, I don't understand what's your question. ABC, your questions are not clear. For example, I invest in shares or I invest in debentures. If I feel that kind of a share, like for example, B group, I may think of a short-term gain and I do trading. Or I might invest. Yeah, I think ABC, you are not dealing with the questions properly. The questions are not proper. So if it is notional loss, it will be of OCI, say for hedging. Maybe. I think I am saying that wherever you have treated the hedged item at OCI, the derivative being a hedging instrument is also goes to OCI. Notional word, no need to bring it as a hard and fast. How to deal with OCD and OCPS? No, ABC, I think you have some wrong concepts. If in profit it will classify as ऐसा कुछ नहीं है. Profit loss का कोई संबंध नहीं है. You decide you want to trade or not. Sometimes you go in loss also. So don't mix up profit and loss. Your business model or your intention to buy those shares, is it trading or investment, is something which you have to decide. Okay. So don't talk about profit loss, notional and all these things. Let me go through the other questions. How to deal with OCDs, optionally convertible debentures, the investment and OCPS in split between debt and equity? The simple answer to you, Sagar Surana. Then the next is JS to Patel, whether investment in perpetual bond bearing fixed rate of, whether change in the value of instrument through, if it is, no, first of all, perpetual bonds, you are looking from holder's angle, right? If you are looking from holder's angle, then it is an investment in a hybrid instrument. Okay. It is an investment in hybrid instrument. And hybrid instrument, currently there is no split. Currently there is no split. And then you are taking it through, of course, P&L. No OCI. Okay. So if there are no queries, I can find here now there are 40 people still here. Thank you, sir. Showing probability of default, loss given default, exposure, default to calculators. Convert, I will take it in my next lecture because probability of default, etc. will take time. Okay. Then investment in JV, equity investment in other component, preferred shares has to be at fair value every year. See, Mr. ABC, you have to first decide, are you talking about a separate financial statements or consolidation? So obviously you are talking about separate financial statement, and separate financial statement under Ind AS give a choice of cost or fair value. Okay, so it's not like this, but cost is subject to impairment. Okay, cost is subject to impairment. My colleague Anjali has also posted you the future webinars. Okay. Now I would go for MCQ. Any other questions here? Okay. So let me go to the MCQ for you so that you have the privilege of. Yes, advances to supplier is. Choose the answer and write here. Quick, there are 40 people to reply. Otherwise, I'll feel all others are near to sleep. So, I can find the correct answer C, very good, non-financial asset, because when we pay the advance to supplier, it is our asset and against which we are going to get goods and services, so it is non-financial. Yes. Answer this. The B answer is correct, will not be reclassified through P&L because there is no reclassification. I use the word die in OCI. Die in OCI. Yes. Solve this. Third question. All right, correct answer B, solely for payment of principal and interest. B is the correct answer again. Okay, next. Solve this. Correct. A is the correct answer. Next question. No, I have not taught financial liability, so I won't take this. I have not taught this. Okay. So the questions for today are completed. And if there are any queries, feel free to ask. Otherwise, we will call it a conclusion of today's session. Please fill up feedback forms. Anjali, give them feedback forms. And right now I'm remaining in the chat mode to take your questions. Otherwise, one or two more sessions will be held in order to complete this topic. And those who have missed out this topic and want to appear in the angle of valuation exam or IFRS exam, they are welcome to ask me any queries. For this presentation, you must be in the WhatsApp group made through a registration through the Google form. Then only you will get the presentation. So if you are directly joined through the link, then the presentation may not reach you because we don't know who you are, barring the name which you are written here. Anything else? Okay. Right. So with this, I conclude the program. Thank you. All the best. And please write the feedback form. What is the reason for compulsory convertible debentures with fixed to fixed criteria? Qualifies. First of all, are you saying interest bearing or otherwise? Okay. The interest bearing has to be split between debt and equity. And since it is the principal part is getting converted to equity, it qualifies as equity. Whereas fixed to variable means the fair value of the equity which is going to be allotted will be determined based on the value. See, what are you giving in return? Are you giving a fixed number of shares? It means the appreciation or loss in the value of shares will be changed. Harish Rameja ji, I am honored by your compliment. And with this, Anjali, can you take a photograph? And I request everybody to come on the video mode so that we can have a photograph, please.
Yes, sir.
Yeah. Please come on. Mr. ABC, I don't know your name, but thank you for your good words. So all of you, please come on this thing. BG sir is also here. Govind Rajan sir, Harish sir. Harish sir, please come on the video so that Anjali can take a photograph. Pallavi, you're not visible. You're looking totally black. Okay, now you are. Hardik, Reddy sir, DP Singh, JS2, Rajaram, please come on the. I think there's a good number of people. Malviya ji, thank you. Kishore, thank you for joining. Harish sir is not there. Anjali, have you taken the photograph? So that it can go in tomorrow's newspaper.
Yes, sir, I've taken.
All right. Okay. Big thanks from me. Please fill up the feedback form and await for the next webinar declaration to complete the balance Ind As 109. My idea is to put very simply so that Ind As 109 doesn't remain a big boogie, it's a difficult standard. And I show some tough slides, the answers of which are not understandable. Let's not do it. All right. Thank you. Bye-bye. Happy Dasara and Vijayadashmi to all of you for this auspicious occasion. I thought that today's day I must invest in sharing knowledge, whatever limited knowledge I have. And it's not humbleness because Ind As 109, more and more you keep on learning every day. In fact, in the future sessions, I will share some funny financial instruments which I came across. Thank you and bye-bye. Meeting is concluded. You can leave the meeting.
Thank you, sir. We are also happy to share.
Yeah. Fill up the feedback form. I hope you are given the feedback form. Anjali?
Yes, sir.